Today we're going to talk about the Container Store, TCS stock. Currently selling for an $83.7 million valuation, $1.62 a share. Let's go ahead and take a look at some of the financials. What do we think about this stock? Are they undervalued or are they going bankrupt soon? We'll start with the income statement, change it to quarterly, and again, I am exporting all this again to the Excel spreadsheet. This is quarterly data we'll be looking at first. We'll go ahead and look at annual data in a sec. Alright, first thing we'll talk about is the total revenue and earnings per share. As you can see, not doing well. For total revenue, they have 5 quarters of consecutive negative growth, and earnings per share, it's going to give you 6 quarters of negative earnings per share growth. Now, what are the reasons for the cause of this slowdown? So this is from the latest transcript they just posted. Consumer spending impacted by long-term inflationary pressures, substantially increased interest rates, and overall market uncertainty. Pretty much that is what they're saying is causing the year-over-year decline in their customer traffic and fewer units being purchased by them. So one of the biggest red flags for me right now, we'll go ahead and go to annual data. So we'll go ahead and go to balance sheet real quick, switch to annual data. They have 10 million in cash compared to 168 million in long-term debt. They are also paying around 19 million in interest expenses. In order for them to pay off this debt, they're going to need to pull out more debt. Currently, for the past 2 years, in net income, they are making negative net income. On the bright side, there has been a lot of insider buying in 2023. Everyone from the director, the CEO, the CFO, they've all been buying while the stock's been crashing. Also, they are still planning to open 5 new stores in 2023 and 4 new stores in 2024. So with all this insider trading happening, there's also new stores that are opening up. They must know something that we don't. There must be some hidden value that the company still holds, and that is the reason why they are still buying. So let's just paint a scenario where the Container Store does shut down. What happens next? Well, they're going to have to liquidate all their assets first. They're going to have to get rid of the real estate. They're going to have to pay back their shareholders, and they do all that after they pay off their debt. This is a little liquidation valuation sheet that I have. I'll go ahead and make it a little bigger. Basically, it's going to take your assets with an assumed recovery percentage, and we're going to take all our liabilities, current liabilities and long-term liabilities, and subtract it from our total assets, and it should give us a number on how much the stock price would cost if they liquidate all of their assets. So this is just data that I took straight from the balance sheet. We're looking at annual. As you can see right here, we have 10 million in cash. I just inputted that straight into the sheet. Assumed recovery of cash, since cash is king, they're going to get 100% of their cash back. The liquidation value on the cash, you will get 10 million back. Now for the accounts receivables, money that hasn't been received yet, they have 23 million. So we'll go ahead and put that in, 23 million, and we just assume, this is all just assumption. We assume that they only get 85% of that 23 million back. It's going to give us 19.5 million. Inventory, they have 173 million in inventory, and assume the company gets liquidated. Let's just assume that they only get paid 60% of that 173 million. That's going to give us 103 million in inventory as liquidation value. So we do all that, we put all those numbers in. So a big number that's going to help them out during liquidation is their long-term assets, and that's going to be their net property, plant, and equipment. 514 million in real estate, pretty much. So we go ahead and put that in. Net property, plant, and equipment, 514 million, and we're just assuming they only get 80% of the value back, which still gives us 411 million in net property, plant, and equipment. Again, we just put in the rest of the numbers. So we move on down to the liabilities. Again, we are just taking this straight from the balance sheet annual data. We have accounts payable at 65 million. Accounts payable 65 million. Again, we put it right here. Accrued expenses at 37 million. We put all that in. And again, liabilities is something the company has to pay. So this is, we're going to subtract this all from the total assets that we had up here. This current portion of the lease, so they do have to pay their lease, 61 million in rent payments that we put in. We'll go ahead and put that in right here. So again, this is all an assumption, guys. It's saying right here total current liabilities is around 166 million. If we go to the current liabilities here, it's saying around 204 million. So I just didn't put in some of the smaller numbers, but again, this is all an assumption. All right, so we put in the long-term debt, 168 million of long-term debt. Other long-term liabilities and deferred tax liabilities at 43 million. So it's going to add up all those numbers. It's going to subtract, this number right here is your value to shareholders. Basically, it's going to subtract all the liabilities from your total assets. And just a quick note, real quick, guys. When we go to the long-term liabilities, I have left out capital leases. So capital leases, they have 323 million in capital leases. As you can see, I didn't put it here real quick. I'm going to do a separate calculation without it real quick. So why am I doing a separate calculation without it? Because under the bankruptcy rules, existing lease agreements will be affirmed, amended, or rejected. So we're not really sure what's going to happen with those capital leases. So we're going to do two different scenarios. Okay. So anyways, value to shareholders, this is what you're going to get after you pay back all of your liabilities and you subtract that from your total assets. You divide it by the shares outstanding, which is going to give you $3.29 for the value of the share. Currently right now, Container Store is selling at $1.67. So let's change the scenario and put capital leases here. Those capital leases in. So 323 million in capital leases. Let's see what it does to change the value of the liquidation. So dramatic change. If you add in those capital leases, say they have to pay those capital leases back. Basically, the company's not worth anything. It's going to give you a negative value for the per share value of the company. So again, everyone, this is just an assumption. I just kind of threw in some numbers on how much the company would be worth if they do a liquidation of the whole company and they go bankrupt. The more likely scenario is they do have to pay back their capital leases, so it's going to give you a negative value for the value of the shares. Anyways, just a quick rundown, $1.67. I would be careful investing in this company. Again, they only have $10 million in cash with so much debt, so much liabilities. If you are a gambler, they could announce something that could shoot up the price of the stock. But if you are more of an analytical person, I would be careful with this company. Let me know what you guys think. The Container Store, TCS stock.